Hello and welcome to SIP TV from TrustNet Direct. I'm with Greg McClymont today, who's Head of Retirement at Aberdeen Asset Management, one of Europe's biggest asset managers.
Hello John, it's a pleasure to be here today with you.
So Greg, here's a scenario for you. You're 2 or 3 years away from retirement, you've been investing in your pension, you've collected up a whole pot of investments. What should I be doing with my portfolio to get it on track for retirement?
Well, getting close to retirement is coming in some ways to the crunch, isn't it, John? I mean, if we think about attitudes to annuities, so you and I can give our opinion, and I'm sure we will, but if we look at consumer attitudes, annuities certainly at age 65, 66, 67 don't appear a popular choice going forward for savers and investors. And there's pretty straightforward reasons for that. The most important is that annuities derive much of their value from mortality pooling. And now with people living longer, faster, the situation is that actually an annuity age 65, the value of it is probably less than many savers, investors, retirees are prepared to accept. So that leads you, of course, into the world of drawdown, and then there's a number of choices we have to think about.
Okay, so drawdown for those people who just were thinking they were going to be an annuity and they buy it and forget it and they get an income all their lives. Drawdown is where you keep your investments and you just take out the money, kind of like a cash point. Am I wrong there?
Well, I mean, I think it's very important to try and keep it as simple as possible. So, I mean, the analogy I don't think is an awful one. The way I would describe it is staying invested through retirement is really what drawdown's about. And an annuity, of course, what do? You basically, it's an insurance contract which you sign, you hand over your capital, and in return you get an income for life guaranteed.
Yep.
Drawdown, of course, means staying invested, taking more decisions yourself, potentially, if not through an advised process. And that really means thinking more about asset classes, about the fees and charges levied, and really having a view of where you want to be through your retirement.
Okay, interesting question for you from a fund management business. Should you be trying to defend your capital and living off the income? And in which case, how much money do you think you really need if you say looking for sort of £3,000 or £4,000 a month income? Do you need a huge capital sum?
Well, if we do some simple arithmetic and think about a yield from investments which is reasonable to expect over time, an annuity currently pays 3.5% guaranteed, really. If you have a pot, you'll get 3.5% every year until you die from that, more or less, on an annuity which is increasing in value with inflation. Yeah. Straightforward annuity. I would say looking at investments, a reasonable expectation is above that, but once you start thinking about 8, 9, 10% or so on, you're having to take a lot more risk. Yeah. So really it's a trade-off between risk and reward. What's your risk tolerance? What's your appetite for risk? And very importantly, can you absorb losses? Because drawdown and staying invested in retirement raises very quickly the issue of sequencing risk, yeah, which exists in accumulation, yeah, and your viewers will be aware of it. Yeah. But in retirement, decumulation, to use the jargon, it's a bigger problem potentially, because if you are cancelling units to draw income and you're having to do that in a period of market volatility, indeed downturn, then it has a significant effect on the size of your portfolio. You're having to crystallise losses. Yeah. So I think that's something really important to bear in mind when we're talking about income drawn from investments. Okay,
so we're in a pretty choppy market at the moment. Markets are well off their peaks. If I was retiring now, I presume buying an annuity would be a bad decision, and starting to cash in your investments is a bad decision. What should people do now? Should they stay working, or if they have that option, what should they do?
Yeah, annuities, of course, have, alongside the issue of increasing life expectancy and the loss of value from mortality pooling, at least in the early stages of retirement. The other issues with annuities, of course, have been low and long gilt yields, which have had a big effect on the value of annuities that one can gather. In Drawdown, this market volatility as things stand really illuminates that issue of how much risk can an investor afford to take, because can you just draw an income from the yield, natural yield? I think in most cases you're going to have to accept that there'll be some capital drawdown. After all, that's the word drawdown suggests. And I think it really depends on your size of pot. If you have, say, a pot of £500,000, you can probably afford perhaps greater exposure to equities. Now, there's lots of modelling which suggests in the long run equities perform better than other asset classes, but as Keynes once said, in the long run we're all dead. And what is your risk tolerance as an investor? Can you sit out these periods of volatility without getting involved in really a damaging way in crystallising losses via drawing an income? So some very tricky decisions to think about. My own view is diversification is absolutely critical. A diversified portfolio which provides income but also growth is going to be crucial. And then that takes us on to the question of how one does that.
Excellent. Greg McClymont, Aberdeen Asset Management, thank you. If you want to do some retirement planning for yourself, we've built some really handy retirement tools covering the 3 stages of retirement: planning, approaching retirement and post-retirement, and you'll find them all on the TrustNet Direct website.